Gold just hit an all-time high. Central banks are buying it at the fastest rate in 50 years. Retail investors are piling in. Financial advisors are recommending it as a hedge against inflation, currency debasement, and geopolitical uncertainty. Every financial publication has a cover story about why gold is going higher. Warren Buffett has watched every gold boom of the last 60 years. He has never bought significant gold. Not once. Not in 1980, when gold hit what was then an all-time high and the financial press declared it the only safe asset. Not in 2011, when gold reached $1,900 amid fears of dollar collapse. Not in 2020, when gold surged past $2,000 during the pandemic. And not now, at current all-time highs, despite owning $330 billion in cash that could be deployed into anything. His reasoning is not vague. It is specific, mathematical, and more compelling than most gold critics bother to articulate. In this video, I am going to lay out Buffett's exact case against gold, the 5 arguments he has made across 60 years of shareholder letters, annual meetings, and public interviews. Argument 3 is the one that changes how most investors think about what gold actually is. And once you understand it, the case for gold looks very different from what its proponents suggest. Stay with me. Before we get into Buffett's arguments, let me be honest about what this video is and is not. This is not a video about whether gold will go up or down in the next year. Nobody can reliably answer that question, including Buffett. This is a video about Buffett's framework for evaluating gold as a long-term investment. Specifically, why he has consistently chosen to own businesses and productive assets instead of gold, across every market environment of the last 6 decades. His most detailed statement on gold came in his 2011 shareholder letter, written when gold was approaching $1,800 per ounce and gold bulls were at peak confidence. He wrote what remains the most precise articulation of his case against gold ever published. He started with a thought experiment. Imagine, he said, taking all the gold in the world, approximately 170,000 metric tons at the time, and combining it into one giant cube. That cube would be approximately 68 feet on each side. It would fit comfortably within a baseball infield. At 2011 prices, that cube would be worth approximately $9.6 trillion. Now, he asked, what would you rather have? That cube of gold, which sits there, does nothing, produces nothing, and simply exists, or the following: all of the cropland in the United States plus 16 companies the size of ExxonMobil, with $1 trillion left over for pocket money. Both cost the same amount. One produces nothing. The other produces hundreds of billions of dollars in earnings every year, grows those earnings over time, and feeds a significant portion of the world's population. That thought experiment is the foundation of Buffett's case against gold. What follows are the 5 specific arguments that build on it. Gold produces nothing, the sterile asset problem Buffett's argument. Buffett divides investable assets into 3 categories. The first category, assets that produce something. Farmland produces crops. Rental properties produce rent. Businesses produce earnings. Bonds produce interest. These assets generate cash flows that can be reinvested, distributed, or used to purchase more productive assets. Over time, the cash flows compound. The investor receives more than they put in, not just in nominal terms, but in real purchasing power. The second category, assets that do not produce anything but can be sold to someone else. Gold is in this category, sits in a vault. It generates no interest, no dividends, no earnings, no rent. Its only return mechanism is selling it to someone who will pay more than you paid. That requires finding a buyer willing to pay a higher price, which depends entirely on sentiment, not fundamentals. The third category, currencies and currency equivalents, which Buffett views as the least attractive of all. The evidence over time, over the very long term, productive assets have dramatically outperformed gold. An investment in the S&P 500 in 1965, when Buffett took control of Berkshire, has returned approximately 34,000% by 2024, including dividends reinvested. Gold over the same period has returned approximately 4,500%. Gold's proponents correctly note that gold has had extended periods of outperformance, particularly in the 1970s and the 2000s. But both of those periods coincided with unusual conditions: the breakdown of Bretton Woods and the stagflation of the 1970s, and the exceptionally poor stock market returns of the 2000s combined with dollar weakness. Outside of those specific environments, productive assets have consistently outcompounded gold over multi-decade periods. What this means? The question Buffett asks of any investment is, what will I have at the end of 10 or 20 years relative to what I have today? For a productive business, the answer is more earnings, more cash flow, possibly more shares through dividend reinvestment. For gold, the answer is the same quantity of gold, whose value depends entirely on what someone else will pay for it at that future date. Argument 2 is about fear, and why Buffett thinks gold's primary appeal is based on a misunderstanding of what actually protects wealth during crises. Fear is not a thesis. Crisis performance is more complicated than gold bulls admit. The gold bull case Buffett addresses. The most common argument for gold is that it protects wealth during crises, that when everything else falls, gold holds its value or rises. This is the case made by central banks, by gold ETF marketers, and by financial advisors recommending it as a portfolio hedge. Buffett's response is not that gold never rises during crises. Sometimes it does. But sometimes rises during crises is a much weaker case than gold advocates typically present. The reality of gold's crisis performance is more nuanced and less consistently protective than the conventional narrative suggests. The evidence. During the 2008 financial crisis, the worst financial shock since the Great Depression, gold initially fell along with everything else in the acute phase of the crisis. It then recovered and rose as fear persisted. Investors who bought gold in 2007 as a crisis hedge did reasonably well. But so did investors who simply bought U.S. Treasury bills, with no volatility and guaranteed return of principal. During the 2020 COVID crash, gold rose, but so did U.S. Treasury bonds, which many investors held without paying the storage costs, transaction costs, and bid-ask spreads associated with physical gold. Buffett's argument: if your goal is capital preservation during genuine crisis, short-term U.S. Treasury bills accomplish that goal with less volatility, no storage cost, and a positive nominal return. Gold accomplishes it sometimes, but with significant volatility and zero yield in normal periods. What this means: if your reason for owning gold is crisis protection, be specific about what scenario you are protecting against. Gold performs well in some crises, particularly those involving currency debasement or extreme inflation. It performs poorly in others: deflationary crises, liquidity crises, or sharp risk-off events where investors sell everything for cash. Treasury bills perform well across a much wider range of crisis scenarios, with no storage cost and no liquidity risk. Argument 3 is the one I mentioned at the start, the reframe that changes how most investors think about what gold actually is. And it comes directly from Buffett's 2011 letter. Gold is not an asset, it is a bet on fear. The reframe Buffett's peak argument. Buffett makes a distinction that gold investors rarely articulate clearly between owning an asset and making a bet. When you own a productive asset, a business, a farm, a rental property, your return is generated by what the asset does. The business earns revenue, pays expenses, generates profit. The farm grows crops. The property collects rent. Your return is produced by the activity of the asset, not by what someone else is willing to pay for it. When you own gold, your return is generated entirely by what someone else is willing to pay for it in the future. That price is determined not by anything gold does, because gold does nothing, but by the collective level of fear, uncertainty, and distrust of other assets at the moment you want to sell. Buffett frames this directly: gold is not an investment in a productive enterprise. It is a bet on future fear. If the world becomes more fearful, gold rises. If the world becomes less fearful, gold falls. You are not investing in anything that creates value. You are speculating on the emotional state of the global population at your exit date. Why this reframe matters. This distinction changes the analytical question entirely. Most investors who buy gold think they are buying safety. Buffett argues they are actually making a specific prediction, that the world will be significantly more fearful when they sell than it is when they buy. That is not a safety position. That is a bet. And it is a bet with a specific asymmetry. If fear rises dramatically, a currency collapse, hyperinflation, geopolitical catastrophe, gold performs exceptionally. But these are low-probability tail events. In the vast majority of economic environments, including recessions, normal inflation, moderate political instability, and financial market volatility, the productive assets that generate real cash flows have outperformed gold over meaningful time periods. You are giving up guaranteed cash flow generation to own exposure to tail risk fear scenarios. Buffett considers that a fundamentally poor trade for a long-term investor who does not need that specific tail risk protection. What you do with this? If you own gold right now, ask yourself honestly, what scenario am I betting on? If the answer is, I expect the world to become significantly more fearful over my investment horizon, that is a legitimate thesis to hold. But be explicit that it is a bet on sentiment, not a bet on productive value creation. And ask whether the current price at all-time highs already reflects significant fear. If it does, you may be buying the peak of the fear trade, not its beginning. Argument 4 is about what Buffett buys instead, the specific attributes he looks for in assets that he considers the genuine alternative to gold. What he buys instead: businesses with pricing power beat inflation, the alternative Buffett prefers. The most common reason investors buy gold in 2026 is inflation protection, the fear that paper currencies will lose purchasing power over time and that gold will maintain its real value. Buffett does not dispute that inflation is a real risk. He has lived through periods of 13% inflation. He has seen what sustained inflation does to fixed-income investors and to businesses with weak pricing power. But his answer to inflation is not gold. It is businesses with strong pricing power, companies that can raise their prices in line with or ahead of inflation, protecting their real earnings regardless of what happens to the purchasing power of the currency in which those earnings are denominated. The specific evidence: Coca-Cola has raised its prices consistently for over a century, through every inflationary and deflationary period. Its earnings in real terms have grown substantially even during periods of significant inflation, because it can pass cost increases to consumers who keep buying regardless. Geico reprices insurance policies annually, adjusting for claims cost inflation automatically. BNSF adjusts freight rates in contracts that often include inflation escalators. See's Candies has raised its chocolate prices every year for decades, maintaining margins regardless of cocoa or sugar price movements. These businesses do not just protect against inflation. They compound through it, generating earnings that grow in real terms because pricing power more than offsets cost increases. A bar of gold in 1965 is still a bar of gold in 2026. This purchasing power has increased, but so has its price, making new buyers pay increasingly more for the same inflation protection. Coca-Cola in 1965 has compounded at rates that far exceed inflation, producing returns that dwarf what gold has returned over the same period. What you do: if your reason for considering gold is inflation protection, compare it specifically to businesses with genuine pricing power. FMCG companies, utilities with inflation-linked contracts, railroads with volume-based pricing, consumer brands with loyal customer bases. These are not as dramatic as gold in a crisis, but they generate returns in normal environments as well as inflationary ones. Over 20 or 30 years, that combination almost certainly outperforms gold purchased at all-time high prices. Argument 5 is Buffett's most personal one, and it reveals something about his view of human progress that most investors who follow him have never fully absorbed. Betting on gold is betting against human progress, Buffett's deepest argument. At the core of Buffett's case against gold is an argument about human civilization that goes beyond finance. He is, fundamentally, an optimist about the future of human productivity and ingenuity. He believes that people, over time, find ways to produce more value, to grow more food, to manufacture more goods, to develop more technology, to create more wealth. And that belief leads him to invest in the vehicles that capture that value creation, productive businesses. Gold, by contrast, performs best when human optimism collapses. It rises most dramatically when civilization appears to be in genuine danger, when currencies collapse, when governments fail, when wars destroy economies. It is the asset of last resort precisely because it does not depend on any system, any institution, or any government functioning properly. Buffett's view: buying gold is an implicit bet that the optimistic scenario, continued human progress and prosperity, will not materialize. He is not willing to make that bet. Not because catastrophic scenarios are impossible, but because he believes betting against the long-term productivity of human civilization is the wrong default position for any investor with a long-time horizon. The honest counter-argument. It is worth noting that Buffett acknowledges the counter-argument. A small allocation to gold, say 5 to 10% of a portfolio, as a genuine tail risk hedge against civilizational collapse scenarios is a defensible position for investors who are genuinely concerned about those risks. His objection is not to gold in all circumstances. It is to the treatment of gold as a primary store of value, or as a superior long-term investment to productive assets. Central banks holding gold as a reserve asset have specific reasons, political independence from any single currency, that do not apply to individual investors with long-time horizons. For individual investors with 10, 20, or 30-year time horizons, Buffett's position is that the probability of a scenario requiring gold as a genuine store of value is low enough that the opportunity cost of holding it, relative to productive assets, is not justified by the expected tail risk protection it provides. The final question. Ultimately, Buffett frames the gold question as a question about your view of the future. If you believe human civilization will broadly continue, that economies will grow, that businesses will generate earnings, that productivity will increase, then productive assets are the right vehicle. They capture that progress. If you believe the system will fundamentally break down, that currencies will collapse, that institutions will fail, that the optimistic scenario will not occur, then gold is the right hedge. It does not depend on any system functioning. Buffett has consistently chosen the optimistic bet, not because he is naive about risks, but because 100 years of evidence suggests the optimistic bet has been correct far more often than the pessimistic one, and he sees no reason to change that assessment at current gold prices. 5 arguments. 1 consistent position, maintained across 60 years and every gold boom in between. Let's bring it together. Argument 1. Gold produces nothing. The return on gold is entirely dependent on what someone else pays for it at your exit date, not on any productive activity the asset performs. Argument 2. Crisis protection is more complicated than gold bulls admit. Treasury bills protect against most crises with less volatility, no storage cost, and positive yield in normal periods. Gold protects specifically against fear-driven scenarios, and only some of them. Argument 3. Gold is not an asset. It is a bet on future fear. You are not investing in value creation. You are speculating on the emotional state of the global population at your exit date. Argument 4. Businesses with pricing power beat inflation more reliably than gold, with returns in normal environments as well as inflationary ones. The alternative to gold is not cash, it is productive assets. Argument 5. Buying gold is implicitly betting against human progress. Buffett's optimistic bet on continued human productivity and ingenuity has been validated by 100 years of economic history. Let me be honest about what this analysis does and does not mean. Buffett is not saying gold will go down. He cannot predict gold prices any more than anyone else can. Gold at all-time highs may go higher. The fear and uncertainty driving it right now is real and may intensify. What he is saying is that over investment time horizons of 10, 20, or 30 years, he would consistently rather own productive assets than gold. Not because gold never works, but because the expected return from ownership of businesses with real earnings and real pricing power has consistently exceeded the expected return from ownership of a non-producing asset bought at peak fear and peak price. That is his position. It has been his position since 1965. And nothing about the current all-time high in gold prices has given him a reason to reconsider. This wraps up Week 5. 3 trending videos, the Federal Reserve, artificial intelligence, and gold, all through Buffett's framework. Next week, we continue the series. The next video is right here.